Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Leadership. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Maradi, who looks after the investment side of things, particularly the direct shares investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today.
So, Dan, in terms of the holdings that Lonsec currently has in particularly the direct side of the portfolio, what, I guess, shares do you think will perform well, and which ones do you think might not perform as well in this cycle we're entering now?
Sure. Look, I think from a even from a holistically perspective, as we saw sort of this environment developing over the last 2 years, we've made sort of real moves in terms of adjusting our portfolios. Obviously, we've had more tangible evidence in recent times that the extent of inflation and the extent of potential tightening by central banks. And the first part of the portfolio that we needed to adjust was the bond allocation. Obviously, given that's not a positive tailwind when we got rising interest rates and inflation for that asset class, and to combat that, we maintained our underweight exposure to that part of the market and introduced active managers to manage the interest rate and duration risk. But on the equity side of the portfolio, once again, we've gone through all the holdings that we've had in the portfolio to make sure they're not negatively impacted by what's happening from a bottom-up perspective, and obviously how they would fare in a scenario of inflation and rising interest rates. And basically, it sort of goes down to factor exposures within the portfolio. We've given the quality bias that we've had. We usually have overweight allocations to the quality parts of the market. Your healthcare, consumer staples, your stronger growing companies, and an underweight position to your volatile cyclical businesses like resources, which have a lack of visibility from an earnings perspective. So we don't want to have too much of the portfolio exposed to that to those segments of the market. But what we've done over the last 2 years per se, we've gradually upweighted exposure to the major banks. As I said, financials should do well in this environment, and higher interest rates is good for bank margins. And they've fared pretty well throughout COVID. So that's a sector that should do relatively well. We've increased our cyclicals exposures within the portfolio. We've added companies like Computershare, Suncorp, and Cube, which are businesses that are most cyclical, that have upside leverage to their earnings because of higher interest rates. In terms of Computershare, in terms of the massive cash flow that they have in their business, which will benefit from higher interest rates. Insurance within Suncorp should do well in an inflationary higher interest rate environment, and Cube being a proxy for economic growth in Australia, once again should do well. And at the same time, what we've done is try to lower the exposure in the portfolio to the defensive growth sectors of the market that have done quite well in the last couple of years. We've removed Coles from the portfolio, maintaining the Woolies exposure, and we've sort of reduced our healthcare exposure in terms of just trimming positions and taking profits in the likes of CSL and Sonic Healthcare that have done quite well. Once again, nothing wrong with those businesses from a bottom-up perspective. It's more about the group of companies that we have exposure to in the portfolio to make sure that that we have some increasing embedded inflation protection in the earnings for these companies that don't lag too far behind in such an environment. And we can continue to make adjustments depending on what the outlook for that inflation is, because initially it started out as being a transitory issue because of COVID, and now there's other factors that have come to play. So it's just about actively managing the portfolio to get through this phase.
Dan, just on that, like those, I definitely seen some of those changes, and like, you're referring more to the core or to the income, or a bit of both?
Just purely the core, in terms of, obviously that's the flagship product that feeds into the multi-asset portfolio as well. So it's from that perspective. The income portfolio does have a higher exposure to bond proxies and more mature businesses, as you would expect in terms of dividends. So we can have a higher collection of growth stocks in there, but bond proxies suffer in this environment as well, because once again, they've had the tailwind of 10 years of low interest rates, being a positive factor for valuations. And now when you can get 3% on a 10-year bond yield, a 3% dividend yield on an infrastructure stock is not as attractive. So that's what the market has derated. Once again, nothing wrong from a bottom-up perspective. It's right now the biggest factor in the market is relative. It's the underlying fundamentals is less important. It's what's relatively better at this stage, and that could change at any time if the outlook for interest rates or inflation changes.